Good day. I'm Martin Gago with Market Radius Research. It's Wednesday, April the 12th, and we've got CEO Nick Blitterswyk of UGE International. UGE owns, operates solar and battery energy storage system projects in the U.S. The UGE just announced its 2022 financial results and also provided its Q1 23 business update. Nick is going to give us a very brief overview on that, and then we're going to get into a discussion on UGE's evolution and what 2023 should look like. I'm really looking forward to this conversation. I've known Nick now since soon after they went public back in 2015, and the company has evolved and grown significantly since then. I suspect that 2023 could be a transformative year for the company, where positive cash flows and growth really gain traction. And I'm looking forward to discussing and really understanding the company's evolution and its business model currently after they had changed their model a few years ago. But please remember, this is not a recommendation nor investment advice. We're here to learn about the company. Nick, thanks a lot for joining us. Please start off by giving us a brief review of 2023 and your just released Q1 business update. And thanks for joining us.
Yeah, no, thank you as well, Martin. Great to see you again, and thanks for having us. So just to go off the top there, so I know that a lot of the people that are on the call today will already be familiar with the company, and I know, Martin, you were kind enough to have us on. I think it was close to a year ago. So this is more update, and then the company really has been growing really quickly. So we're looking forward to getting into greater detail on how the portfolio is growing and what that's going to mean for cash flows and all the other good stuff as well. Just off the top, so we put out our 2022 year-end numbers last week, and so I think you start to see the seeds of the growth happening there. So number one is our recurring revenue, which is really what we care most about. That grew 85%, still at 0.4 million, but I'll talk shortly about how that's going to grow. Those recurring revenues have really high gross margins. So you see here 93%. We've been guiding for those numbers to be 85% or better. So we're looking forward to seeing that continue to grow there. The operating portfolio grew or more than doubled, so 160% to 2.3 megawatts. Again, it's a number that's still small compared to what we're expecting to see at the end of this year and going forward, and you'll see that more in our Q1 milestones here shortly. The backlog measure, which we also track, it grew 76% last year to 260 megawatts, but another number that just keeps growing. Another thing is we're continuing to be really successful on different types of project fundings, and I think we'll talk about this more as well. But one aspect of that was the green bond, which we issued almost 10 million US of green bonds last year. That's a product that's securitized by our project portfolio, and then also as these projects come to NTP and COD as they're getting built out, we do various types of project debt and tax equity fundings too. But we'll talk about that a bit later. But every one of those fundings that we go through a whole bunch of due diligence and check a whole bunch of boxes with banks and other types of funders that we're working with. So A, I'm proud of the team, but B, I think it also speaks to the level of the low level of risk that I think those traditionally pretty conservative funding sources will look to fund, and also the strength of our projects there. And then lastly, in terms of the 2022 highlights we have here, we continue to scale up the team. So in November, we were joined by Andrew as our Chief Commercial Officer. He is based in Toronto. He was the co-founder of a group called CleanMax. They are in many ways a kind of preeminent, they call themselves a B2B developer, but it's a similar type of term to what we do. They're mostly developing projects for corporate off-takers, and he counted among his clients groups like Apple and Cisco and many other big names. So he was a co-founder there. That was acquired by a large PE fund, and then he joined us in November as our Chief Commercial Officer, where he's been leading up development and off-taker relationships, among other things. And then it was actually in early 2023, but Trevor Weed joined us as our COO. He was previously the COO of a company called Blue Raven Solar, which he was really instrumental in growing from a few million in annual revenue to over 200 million in annual revenue before it was acquired by SunPower a little over a year ago. So we're really happy to have both those folks and other members of the team as well. And then also, we've been 2022 is the second year in a row where we added more than 100 megawatts of backlog. But really the overall organization, we're looking to be a company that delivers 100 megawatts of projects to commercial operation per year. And given the sort of 3-year time life cycle of these projects to bring them to that commercial operation point, I think we're only a 1 to 2 years away from the point where we can be building out 100 megawatts of projects per year. And that's really what we're focused on here for the team. We also announced earlier this week our Q1 milestones. This is something we do typically about a week into each quarter to summarize the prior quarter's main KPIs. So backlog, we actually added more backlog in Q1 of 2023 than we ever had before. I should reiterate backlog, what that means. So it's a project that we've already been developing. So we have a contract to develop that project. We've filed for interconnection, and then we go through various levels of an investment committee process. But when it enters backlog, that means that our investment committee has signed off to say, hey, this is a project we expect is going to reach commercial operation, and the sort of initial kind of or the binary types of risks we've gone past those main points to get to a point where we're confident that project's going to make it to commercial operation. So this is an important number for us.
Nick?
Yeah.
Sorry, since I've got a lot of terms I want to get defined along through this interview here, and since you brought up sort of defining backlog, let's just stick with that here. So, what is your typical project size? And I'm just trying to or give us a typical size project.
Yeah, a typical size project for us is about 2 megawatts, say.
All
so
right.
Yeah, so 313 megawatts for the total backlog. Roughly it's probably 150 projects or so.
Gotcha. So when a project goes into backlog, we'll call it a 2 megawatt project, how much money have you invested? So it's not just, oh, this is an idea. You've actually invested some resources, some time, some studies and so forth into it. How much money would have you invested into that 2 megawatt project before it sort of goes in or not in the backlog?
Yeah, so I'll answer that at a bit of a high level, and then there is a slide I can go to later, which goes into a bit more detail there. But in essence, if I say, a project takes 2 to 3 years to develop. So what that's going to mean is that in that, let's say 2 years, we are signing a contract with the land or building owner to lease that space, typically to that's going to be the host for where the project is. We're working with the utilities to file applications and do studies to work through the process to get that eventual project connected to the grid. We're going to work with the town that it's in, expediters to go through the permitting process. There's an engineering side to it, of course. We do a lot of the engineering in-house, but we'll go through the engineering of the project as well. But in the gross, if I take a 1 megawatt project as an example, we're talking about let's say maybe $30,000, maybe $100,000 on the very top end of that sort of initial investment over the first couple of years to get that project to construction. There's this other aspect about how the cash flows of the company work, but one of the really good things about our model is that we're developing these assets which are very fundable. And so when we get that project to NTP, when it's cleared for construction, we've monetized the tax credit. We've lined up in essence, the bank debt that lays behind these projects at the project or portfolio level. And so for UGE at that point, it actually turns cash flow positive right away. So as we're building out these projects, we're actually starting to pay ourselves for the work that we're doing to build that project. And then once it reaches commercial operation, we're then capturing the 25 to 40 years from the project.
Okay, so about how long from idea till it falls into backlog? It's 2 years from sort of inception to NTP, I guess is sort of typical what you were saying there.
Yeah.
But how long until it falls into backlog? And how much of that 30 to 100 grand have you invested up until backlog?
Up until backlog, so if I said 30 to maybe 100,000, up until backlog, it's probably, it's almost certainly less than 10,000. So
Okay.
yeah, at that time, it's mostly, our sales folks are investing their time in, I'll say like our overall sales funnel right now is getting close to 3 gigawatts. So about 10 times the backlog. So that's, in essence, like a sales funnel that people would be used to in a different setting.
Yeah.
And so, some of those clients move right away, and sometimes something will come back 3 years later, but that's in essence what they're going through. We have these stages, and it starts with stage 3.0, and that's when we have site control. So we've signed a contract with the land or business owner to host the project. Now, in terms of how long it can get from 3.0 to 3.1, 3.1 being the beginning of backlog, I'd say typically anywhere from like a month to a year, and that's largely going to be dependent on what we identify as sort of the binary risks. So interconnections, the biggest one. If it's on a rooftop, structural review is something that we always do ahead of time, etc.
Gotcha. Okay. And then so it falls into backlog, and then it goes into, and I guess in the next chart it goes into deployment.
Yeah, exactly. So the backlog is, as people that have been following the story know, it's like projects can be a couple, maybe even 3 years in that backlog as they get the approvals and go through the utility timeframe. And then in deployment, now a couple of things I'll say on this. So in deployment, that means we're building it. Deployment's our word for getting it constructed. But yeah, so
And sorry, Nick.
yeah.
Sorry. In deployment, once you get NTP, is it then goes into deployment? Is that sort of the milestone?
Exactly. Yeah. So NTP, what we're going to be doing is we're going to be buying equipment and getting it shipped to site, and then when equipment gets on site, then it'll be in construction, and then some number of months later it'll be operational.
Okay.
Yeah.
And then from when it goes into backlog and then after NTP and it falls into because it goes from backlog to assets and deployment. Is that right? Is that sort of?
Yeah, one clarification is that when it's in deployment, that's actually still part of backlog. That's like
Okay.
the most advanced stages of the backlog. But yeah, we have this numbering system that goes from 3.1 up to stage 5 are all our backlog categories, and really deployment is stages 4 and 5. So NTP and then in construction.
Okay. So when it's in construction, it's still in backlog.
Yeah, that's right. It doesn't fall out.
So it only leaves backlog once you plug it in and it's producing power?
Exactly. Yeah.
Okay.
Yeah.
I thought it sort of moved from backlog into deployment and then into production, but it stays in backlog that whole time.
Yeah, no, exactly. Yeah. And
Okay.
so those stages that I mentioned, we're really starting to see more and more of these projects get to those later stages of backlog, which include construction.
Yeah.
And then we'll see in a second also, like the operating projects are starting to scale up. I'll just say that, so in Q1, we hit NTP on 10 megawatts of projects. We're expecting a similar number in Q2 as well. So you just see like how much that graph jumped in the first quarter. And maybe if I actually just go to the next slide here. So the operating portfolio, it jumped a bit in Q1 because we turned on a project in late January. But compared to the 10 megawatts that we hit NTP on in Q1, this operating portfolio is really, really going to start scaling up the second half of the year here.
Okay, so it hit NTP in Q1, and then in the second half of the year, it comes out of backlog, and then it goes into operating portfolio, and then this sometime in Q3 or Q4 from Q1 projects, it'll go up by 10 megawatts.
Exactly, and more. Yeah, there'll be another 10 or so megawatts in construction here by the end of Q2 as well.
Okay.
But yeah, so we're expecting that portfolio to be around that 20 megawatt mark at the end of this year.
Gotcha. Okay.
Yeah, and just this map on the right just gives a graphical representation for where we are these days. So I was in New York 14 years ago when I started the company. And so the Northeast US has traditionally been a big area of strength for us, but we've also been expanding across the country over the last couple of years here as well. So like, for example, California, there was a lot of stage 3.0 projects that are from California that that we signed up in Q1 in particular. California has a new and improved community solar program that's coming down the pike, and so we want to be ready to do a lot there. But yeah.
All right.
Yeah, so I think, Martin, if in terms of the 2022 numbers and the Q1 highlights, that's mostly what we've been up to.
Okay. All right. So we've gone through the review of there. Sorry, and I'm just going to go back, and sorry if this is tedious for people, but NTP, what does that stand for?
Yeah, so NTP stands for Notice to Proceed, and that means that every box is checked to start building the project. And a couple of things I'll mention on that. So number one is, it's not just us checking those boxes, right? So one of the aspects of NTP is that we've closed on the institutional funding that we use to monetize the tax credit, and then also the bank debt that's used as the leverage in these projects. And so, like, for example, a few weeks ago, we closed financing for 3 projects in Maine. There was almost 100 signatures that I had to give to close that, just to kind of speak to the level of diligence. So when a project is at Notice to Proceed, it's really, we would say, de-risked. As a developer, at that point, the construction is just sort of something that happens to get the project built. You really, as a developer, are creating your value from, in essence, pipeline to NTP. That's where you're getting the value. And in fact, like, we, maybe I'll just flip to it real quick. We have, most of the developers in our space, here it is here, most of the developers in our space will only do part of the life cycle. We're a full life cycle developer that brings these projects all the way through. But if I was a develop and flip company, I would sell it NTP. Like, you don't need to build it to capture the value within these projects. We don't do that because we feel we'll capture a lot more value, and it's a lot more efficient to the companies that we work with to have a full life cycle approach. But yeah, NTP is important for 2 reasons. One is it's like the project is completed in terms of being developed, and number 2 is that's really where the biggest value realization has happened. I should also say that's also where the cash flows change. So once we start building it, we have all the funding lined up. That's where we're no longer spending money or spending cash on the project, but rather we start to actually take it in.
And that's where you were saying for 1 megawatt, it could cost $30,000 to $100,000 to get it to the NTP stage. Is that correct?
That's right. Yeah.
And so basically, everyone, you got your 100 signatures, and everyone, like the utility says, you can plug it in. You've got the buyers for the power. You've got the funding arranged. And you just give the plans to the construction company, who send their guys out there, you buy the equipment, and get that all happening.
Get that all happening. That's right.
All right.
Yeah.
So let's say on a 1 megawatt project, it costs you 30 to 100 grand to get to that point. And what do you think you could sell a 1 megawatt project for roughly at that point, if you didn't want to sort of follow on with it? You just take the cash now.
Yeah. So so we just had these press releases for these Notice to Proceed. So there's 3 of the projects are in Maine. So I'll use those as examples. Those numbers are hot off the press. In those ones, so we get a third-party valuation as part of the process here, and that's a pretty good proxy for what the market is to sell such projects. So the valuation on those projects was about $330 to $340 per watt, so 3.3 to 3.4 million per megawatt. Now, the cost to build those projects is probably around $2 million, $2 a watt. So you're talking about a $1.30 to a $1.40 per watt of net value creation there, or 1.3 to 1.4 million per megawatt. And so your question about what you could sell it for, that's all a pretty good proxy. And so,
Yeah. Okay, so essentially you could sell for a little more than $1 million, you could sell one of those projects. Someone else takes on the construction costs and so forth. Would that be a ballpark, right?
Yeah, that's correct. And it goes without saying that every project and state is a little bit different. I think that
Yeah.
we're probably being a bit conservative on that based on especially for Maine, which is a really attractive market right now. But yeah.
Okay. All right. You and you've mentioned the term COD. What happens at that point?
Yeah, so COD is just commercial operations. That's the date
Okay.
that we turn it on, and then from that moment on, it's generating that 25 to typically closer to 40 years of recurring revenue.
Gotcha. Okay. And what cash flow, like when you start NTP, that's when you start spending money to buy equipment and to get people with hammers and drills and so forth to start installing it. But at that point, that's also when you start getting in cash flows to sort of fund this. What are all the at NTP and that, where does cash go in and out from at that point?
Yeah, so there's really two ways that I'm going to tackle that. So I'll tackle it first just from like a straight cash flow question. And I'll use those three main projects as an example. So on those three, that happens to be 6.5 megawatts. We can prorate that accordingly if we want, but we announced the debt and the tax credit that we had monetized for those three projects, and those two sources of capital totaled about 19.5 million for the 6.5 megawatts, and our cost to build those projects is more like 13 million or $2 a watt.
Okay.
So the thing to note there is that we're actually in large part because the tax credits on these things are so lucrative now, especially in the wake of the Inflation Reduction Act. But just on those three projects, we're expecting $6 to $7 million of net cash flow to the company this year, and I'll just that's like a third of the overall projects we're building this year. So they turn quite net cash flow positive to us once we get to NTP.
And sorry, with that $6 million on that 13 million you're gonna have, who is writing that check to you?
So the way okay, so from NTP to COD, now let's say that's 6 to 9 months, that time frame. So what happens is two things. One is that UGE is acting as what we call the EPC in the industry. Sorry for all the acronyms.
Yeah.
So we're hiring the subcontractors and buying the equipment and so on to build those projects out.
Yeah.
UGE has margins built into our EPC subsidiary that we're collecting as we deploy the project. And then also, once it's gotten to commercial operation, or actually a little bit before that, that's when the bulk of the tax credit money comes in, and that's what really swings things to the positive for us. And so that's within that 6 to 9 month time frame that these projects get built over.
Okay, okay. All right. And then when at COD, you plug it in and you start selling electricity, and you produce electricity and you sell it and you make a margin on that.
Yeah, exactly. And this slide speaks to that a little bit, and it relates it to the overall backlog. So on the left-hand side, we have the 3 to 10 cents per watt that we're spending in the early stages, or 30 to 100 grand per megawatt. Takes 2 to 3 years to get that project built out, and then they start generating project EBITDA over time. Again, every project being a little different. This is meant to be examples. Inflation's actually been quite a boon for our business, just in the fact that inflation has driven energy rates up. And I say that because here we have project level EBITDA of 18 cents per watt per year. I think those main assets are going to be north of 25 cents a watt. But yeah, so once we turn on those projects, we start generating that annual EBITDA from them. I also have in here the number that's net of the debt repayment, because there's an important part in these project fundings that is the debt, of course. But even then, you're talking about a net of 10 cents per watt per year net of debt. And then also, we talked about becoming an IPP as the portfolio scales here. So the current comps analysis has about a 13 times EV to EBITDA multiple. And so you just do the math there versus that 10 cents. And we're at about $1.30 a watt per project, which triangulates to the numbers that we just talked about, right? The sort of $3.30 a watt minus $2 a watt. And we currently have 313 megawatts of project backlog. So just from the current backlog, that overall value generation that we're seeing as we deploy the project over the next few years here is north of 400 million USD.
All right. And going back to the example, I believe in Maine, where you're going to be spending at NTP to COD about $13-14 million to construct the project, right? Did I get that number right?
Yeah, that's right. Yeah, about 13.
And then, but you're also then going to get $6 million back in tax credit. So half of that, of the checks you're writing out at that point, are going to be returned to you.
So in essence, so in essence, what we do is, so there's a concept in the industry called developer fee. And in essence, what that means is as a developer, we're actually paying ourselves back out of proceeds for the fruits of our labor in terms of developing it.
Yeah.
And the other way to think about it is that we're in essence taking like a bit of a part of that $1.30 a watt in this case of that value generation. We're actually taking some of it out of the project early on,
Okay.
which is like big picture why we're pivoting to cash flow positive this year, because we're deploying more and more projects. And as that happens, that developer fee drives cash flow well in advance of actually the projects driving EBITDA and net income on the income statement.
Okay. So your revenues start after NTP, where your EPC, you're generating some revenues internally off of those EPC stuff, your project development stuff. So it's not just when you start selling the electrons, it's when you're doing these sort of management services as well.
Yeah, I think one of the parts that makes it, I think, tricky for investors to follow is that if I just look at the overall consolidated picture of the company, we are building up a recurring revenue portfolio, and that recurring revenue, recurring income from those projects, recurring cash flow from those projects, that's what makes us an IPP, and that's what's going to, drive, we think value growth of the company as this portfolio matures. But one of the benefits of us being a full life cycle developer is that we're not just an IPP, but we're also developing the projects. And so from a cash flow standpoint, we actually pay ourselves back out of proceeds from the tax credit and so on. So that doesn't actually hit the income statement on a consolidated level.
Okay.
On a subsidiary level, it does, because our EPC work is doing work for our internal holdco. But when it's all consolidated together, it's actually just it's the difference between investing income and financing income in essence.
Gotcha. Okay, so it's a cash flow there. So in terms of revenues and EBITDA, that only kicks in when you hit COD and you start sending out electrons.
That's right. That's right. And I have just to kind of like highlight that right there. So this is just starting to scale up now, and I only have 100 megawatts here because 313 would make the graph too silly, the entire backlog. But in essence, like the recurring revenue, which again is, I'd say our average right now is about 35 years of kind of contract lifetime for these projects. But once those projects reach commercial operation, they start generating this recurring revenue. And we're really starting to see it scale up in a significant way here. So 2022, depending on how large your monitor is, you'll see that it started to grow. And I know we covered the percentage growth there earlier, but it's in it's really 2023 and then 2024 where we'll see that number get to EBITDA positive as well, and start to generate larger numbers there.
Okay. All right. Okay, so you don't have any revenues or EBITDA until you go into COD, and then that will build there, but you've got the sort of wave of projects coming in. You refer to the term IPP, independent power producer. It's sort of a self-explanatory name, but IPP, you generate electrons, you sell them, and you make a margin on that. With solar, there's very little operating costs. It's all sort of construction, finance, upfront costs. Unlike, let's say, diesel or natural gas generation, where you got to pay for the input on it. That's what an IPP is, selling electrons at a margin.
Yeah, and I'll say at a margin, our 2022 recurring revenue was at about 93%, right? Then net as a rule of thumb, we're looking at debt that's about 50% loan to value, so pretty modest from that perspective. Earlier we had that slide that showed 18 cents a watt of a project level EBITDA and 10 cents, give or take, net of interest and principal repayment. But yeah, I mean, that's the big picture, is that we're growing ourselves as an IPP here. Frankly, the market doesn't. We don't like the public markets, we don't think see us that way yet. But I think as the portfolio scales up, it'll be hard to miss. And IPPs are valued in a much different way than we're valued right now. So, we're heads down on building out the portfolio and seeing that scale up. But I mean, if you wanted me to there, Martin, just like in terms of an IPP for anyone who's not as aware, so like independent power producer, so it's not a utility, it's someone who owns generating capacity of energy. And then it's like there's a utility aspect to it in terms of the level of surety of the offtake of the long-term revenue from the assets that you have. And as a result of that, the current comps table has about a 13 times EV to EBITDA multiple as the average. So Brookfield Renewable Energy Partners is probably the biggest, most well-known name in Canada. There's names like Boralex and Interjex, and on the smaller side, someone like Polaris. Those are the types of companies that we're building ourselves towards. And then how we stand out. So, number one is, as a developer, we own our own pipeline of future projects. So there's a lot of money that wants to own renewable energy projects right now, and so we think that that's like a pretty key advantage, is that we're controlling where our projects come from. And then also these mid-scale assets that we focus on, they happen to be the fastest growing part of the U.S. solar and renewable energy industry, but they also have higher returns and allow for this kind of equity light model that we've talked about, where there's really only, say, 3 to 10 cents per watt that's out of pocket, and then that's repaid through the developer fee. And then also the 25 to 40 years I keep referencing, there's a very long-term cash flow stream sitting out in front of these projects.
Okay, and just to clarify some terms, so and that is different from a utility, and I don't want to spend a lot of time on this. Utilities have all the power lines and they get it to the customers, and they actually act as your highway or transportation system to distribute it out, right?
Yeah, at a high level, that's right. And over the last few decades, there's been this big deregulation, right? Like utilities, a lot of us will often still think about them as being the producers of the power, but in most cases, that's not the case anymore. And so there's generating capacity, and utilities are, in most markets now, just responsible for the distribution and transmission of that power. So yeah.
Can we talk a little, your main focus is on, you said mid-grade or mid-sized projects that are like community solar. And I just want to go over that community solar model, what that exactly means.
Yeah, so actually, what I'll do is, so just a quick breakdown in terms of the types of projects we do. Right now, it's around 60% that are community solar. We do some direct power purchase agreements, typically on rooftops, or we have a couple of municipal PPAs as well. That's around 10%. And then energy storage has become about 30% of the projects we're developing, and we see that as being a pretty important kind of new frontier for renewable energy. But so community solar, the way to think about it is, some of us on the call live in condos or apartments, or we rent a house, or we just have too much tree coverage, or whatever the case may be. and can't install solar ourselves. And that's true for 80% of households and well over 90% of businesses. So what community solar allows, it's a construct that says we install one project, and then that project has multiple subscribers to buy the credits that are generated. It's in essence, like, people would be maybe familiar with terms like net metering or virtual net metering. And what it allows is, we in essence put kilowatt hours into the grid, and the credits we generate are sold to subscribers that purchase those credits to offset their energy bill or their energy usage. So that's what community solar is. It's growing incredibly fast right now. Both the Biden administration and the Department of Energy have a goal to grow at 8x through the end of 2025, which would make it bigger than the U.S. residential industry. And so we've been a leader in community solar since about 2017, when it really started to take off.
So just simply to, instead of putting a solar on my roof, there's a community solar project. I invest $10,000 in that, and then I get a credit, or I don't get the actual electrons that get driven off of those solar panels, but I'm getting a kilowatt of power, and that sort of nets out against my utility bill. So it reduces that.
Yeah. The important differentiator from what you just said is that you don't put any money up front.
Okay.
Yeah, so you subscribe, and then what'll typically happen is you'll get a bill that says you used 1,000 kilowatt hours from Con Edison.
Yeah.
You purchased 1,000 kilowatt hours from UGE, and so you owe nothing. And so I'm talking about a two-bill system where you would pay UGE separately, but in many states there's one bill that shows all of that together. Now,
I pay a bit
yeah.
to you, and then I pay a bit to Con Edison or whatever, and hopefully it's only on one bill.
Yeah. I muddled that a little bit. Like, in most states, you can have it all in one bill that'll show you how much you offset. And then the benefit, I should say here too, is the standard term is a 10% discount. So you're getting clean energy, but you're also getting a discount. You're not putting any money up front. So
Okay.
it's a real winner for, in the states that allow it, which is now 22 or 23 states across the country.
Okay, that's really neat. All right. Okay. And so community solar and these mid-sized projects is where your focus is now. You're not doing any, I guess the term would be utility scale, like a gigawatt or hundreds of megawatt kind of systems. That's not in your wheelhouse right now. You're just, I guess you could go there, but that's not part of the plan right now.
Yeah, no, exactly. We have, I think we have one project that's above 20 megawatts in our backlog. That's in California, where there's some aspects to the community solar framework there that do or could allow for larger community solar projects. But we're really focused on areas where I guess we're really focused on distributed level, and also on places where there's very strong offtake possibilities. So, like, just to use a rule of thumb, in Maine, when we're selling community solar credits at, let's say, 25 cents per kilowatt hour right now, if we were doing a utility scale project, we might only be able to sell that sell the energy for 8 cents a kilowatt hour or something. So there's a pretty big divide there. But yeah, so we're very much focused on the mid scale.
Gotcha. What the IRA, Biden's Inflation Reduction Act, has had a huge impact on a lot of green industries and technology. What specifically did it do for you? Bigger tax reimbursements, or how did it benefit you?
Yeah, the most near-term tangible benefit is bigger tax credits. So in the investment tax credit, which has been around now for almost 20 years, without the IRA, that we'd be looking at a 22% tax credit this year and a 10% tax credit next year. With the IRA, there's a baseline of 30%, but there's quite a few so-called adders, which increase the number more. So right now we're expecting an average that's somewhere in the 40s. So call it double what otherwise would have been in 2023, and up even more so after that. And so yes, that's the most immediate benefit. And I'll say like a lot of those adders are focused around areas that fit our type of project really well. So low and moderate income communities and capped landfills and various types of things like that. In the short to medium term, the IRA is also driving a lot of onshoring of manufacturing, and that's because the incentives in IRA are really, really strong to produce solar equipment and battery equipment and so on in the US. And so I think that's really going to lead to downward pressure on pricing of components that we use for our systems, and therefore that should be hopefully upward possibilities on the IRRs that we generate as well.
Okay. All right. And all right, I think we've kind of hit the main points that I wanted to go through. Are there any, like we've got a bunch of questions here from the audience. Is there anything you want to highlight before we start taking some audience questions here?
Yeah, no, I think Martin, happy to jump in there, and if there's anything else at the end that I comes to mind, I can blurt it out.
All right. We've addressed some of this, but I'll ask the question, and maybe if there's some nuance or something to this to add. Could you please explain the rough amount UGE receives per watt at NTP and COD? What % of project value does UGE receive upfront at these two milestones?
So in so I think it's better to think about it as like a spectrum between NTP and COD, and as opposed to a certain amount at NTP and a certain amount at COD. And then so the split between how much we're receiving between NTP and COD is variable. If I use those three main projects again as an example, those ones are fairly lucrative projects. So if you just do the mental math there, we're talking about $1 a watt of cash coming out of those projects this year. And the timing of that is probably going to be something like 20 or 25% in the first several months, but the bulk, let's say 75%, will be in the last bit towards commercial operation. So commercial operation is when you kind of be assured that the cash flows have been realized from building out those projects. So it does vary. People shouldn't be expecting us to say to receive a $1 per watt developer fee from every one of our projects, but I think it also speaks to the lucrative aspect of some of those projects we're developing right now.
All right. There's a question here on the term development in a solar project and what steps go through from origination to NTP. I think we've covered that quite well. But in other words, what does day-to-day business at UGE look like? And I guess you've got the origination of projects, you've got your engineering group. What are the sort of divisions? And I guess how many people work at UGE and sort of where do they hand projects kind of off to the different groups?
Yeah, so our main case overall, there's a little over 70 people that work at UGE, and the main groups are origination, development, deployment, engineering, and then aside from that, there's sort of central services and other types of things. But if I look at those four main groups, origination, development, engineering, and deployment, those are all similar size. So let's say an average of 11, 12 people per each one of those groups. Origination is out there working with building owners, landowners, businesses, corporations, etc., to identify good places to develop projects, to negotiate leases with them for us to take over that space to develop a project. The development is, I would say, sort of like the biggest value add area that a lot of people outside of the industry really don't know much, if anything, about. And so it's very multidisciplinary. So you're working with like financial models to understand what the returns of a project are going to be. You're working with both our engineering team, but also some tools we use to scope out what a system is going to produce in a certain area. We're working with our deployment team to understand what the cost to build a project there will be. We're working with regulatory to understand the incentives and regulatory framework and permitting possibilities, et cetera, in a local area. You're working with legal and contracting and things like that. You're working with project finance on how we're going to finance the project. So there's a lot that goes into development, and I think that also speaks to why we're generating the returns that we are, is that multidisciplinary, 14 years of figuring out how best to do these things that comes together for that. And then deployment engineering are kind of overlapped a little bit, but deployment, we are procuring the main pieces of equipment, the panels, inverters, racking, transformers mostly, and then we're hiring local subcontractors to actually put racking up, to put panels on the racking, to do the electrical work, to connect the electrical work. We don't have those boots on the ground, so we are project managers mostly for that. And then engineering, the two things I'll say is, like, as we go through the different parts of the life cycle, there's like different levels of engineering drawings that we do, including the issued for construction drawings, the kind of final package that say this is specifically how it's going to get built. One thing about our engineering is that we stopped actively looking to build projects for other developers several years back, but we still do some engineering work actually for some other leading developers in our space. Our engineering team actually has some business there, and I know that showed up in our income statement for 2022, and I think that's something like 0.8 million or so of revenue we had from that business unit last year. So that gives a sense for who does what.
Gotcha. And I guess when you get to NTP and MPT, and you were saying 100 signatures, it's the development guys who are responsible for most of collecting most of those 100 signatures.
Yeah, two clarifications there. So that was a note about me having to do 100 signatures. So,
okay.
And that is actually our project finance group. So Brent and Luke and other members on the team, that's them working with banks and tax equity partners, et cetera, to come into to those projects.
Gotcha. Okay, on to the next question. I think this is a very good one here. The question is, you will likely need over $600 million to just fund your current backlog. What makes you confident that you can raise those funds? Do you need to raise $600 million?
This isn't the right quantum. I think what I would say is, like, number one, we have quite a track record of working with multiple lenders, multiple tax equity partners, et cetera. The other aspect of this is that we're in an industry where it's absolutely the more the merrier. It is probably just as hard to fund a $2 million project as it is to fund a $200 million portfolio. And the universe of the types of institutions you can work with as you scale up gets bigger and bigger. So from that perspective, we're frankly excited to be raising larger sums as opposed to the kind of smaller portfolios we've had to raise in the past.
Are you going to maintain, I think you mentioned a 50-50 debt equity ratio on the projects going forward? As you get bigger, can you do more debt on those projects and require less equity?
Yeah, we think that's like a healthy balance. And the size of the tax credits are so much that that you could have quite a healthy LTV. I think that for the time being, I think that feels like it's about the right mix. I'll say that, again, at the end of the day, the equity for UGE is really paid in kind, right? We're creating that through developing these projects, so we don't need to fund that for projects we're developing ourselves. But yeah, I think that's the right kind of give or take ratio for us for the time being.
So do you think you're going to need to raise additional equity either this year or just as your project backlog moves up higher numbers and gets to NTP that you need to raise equity to fund that growth?
Yeah, so the answer is we do not. So, and in fact, like this year, you know, I spoke to the cash flows from the main portfolio, or not the three main projects, for example, and that 6.5 megawatts again is about a third or 30% or so of the projects we're building this year. So this is the year where we expect that with our deployments ramping up, we switch to cash flow positive, and you know, and at the same time we have a healthy and growing green bond product that's been really good, I think, for us and the funders that take part in that as well. So yeah, so I think one of the benefits here again of being a full life cycle developer and in this mid-scale space is that the returns are such that we it's very, very equity light.
Okay, so you're going to generate enough cash flow as these projects go into production that you'll get the cash flow out to then recycle it and fund the next project going forward.
That's right. Yeah.
All right. And I guess as well as an alternative, I don't know, you got some bigger projects or you did need some capital, you could sell off some of these projects as well and get them to NTP and then sell them off, generate the cash to fund other projects. You have a fairly liquid portfolio of projects that you have flexibility to work with, right?
Yeah, for sure. Absolutely. There's a very liquid market for these types of assets. In fact, like, I'll just say on a weekly basis, we get multiple calls from folks who are looking to buy projects like this. So, and you know, it even crosses our mind sometimes about, you know, we're big picture, we're building a diversified portfolio, right? And so, hey, if we find that we're getting, you know, or we're kind of overweight in one state or one type of project or what have you, we could always, you know, work from that position of excess to also, you know, sell some projects from that perspective as well. So yeah, absolutely.
Hey, there's a question here of what is the market value of 1 megawatt of backlog? And I'm just going to then preface that or add to this. It really depends on where, if you're early in the backlog or very close to MPT on it as well. Like the later it is, because you've got a big spectrum of early to almost MPT projects within that backlog, right? So it really, like at the end, it's almost $1 million or maybe over $1 million. And at the beginning, it would be much less.
Yeah. So I guess what I would know, what was it? Remind me the first part of that question, Martin.
Okay. What is the market value of 1 megawatt of backlog?
Yeah, so I'll try my best to answer that. Like, you know, of course, different projects will have different values, et cetera, et cetera. But in so a couple things. One is, like, again, pre-NTP, you're going to be able to get pretty close to that delta that we're talking about. Now, like, let's say that you were selling a project a year ahead of time. Typically, what you would see is, okay, so if we just use $1 a watt as a proxy, right? Let's say that a project is NTP and you're getting $1 per watt. Now, let's say you wanted to sell that a year ahead of time. I mean, a common construct would say, okay, you're going to sell it for $1 a watt, even though it's 1 year from now, and we're going to give you 20% now and 40% when this happens, and the remaining 40% at NTP or something like that, right? Like, I think from a developer's perspective, you're going to contract now with milestones that work towards that NTP date. Now, if you sold, like, if you just wanted to completely wipe your hands of something and sell it, then you would sell it at a discount. But it depends on, like, what that line of sight to NTP was. I've seen portfolios of assets that were not much more than just, you know, contract signed and maybe the first interconnection submitted. And so, you know, maybe something that early stage, you might be talking about 10 to 20 cents on the dollar or something like that. But I think a true developer doesn't necessarily need to sell it that early. So
yeah, okay, but all right.
Maybe it's a good excuse, Martin, for me to say, like, I think from a public company perspective. So I think two things. One is we certainly feel like our 313 megawatts of backlog right now and the 400 and something megawatts of site control that's behind that, et cetera. Like, we definitely don't feel like our current market cap or enterprise value is representative of the value that's in there. And so that's on us to get out the good word about the value that is in there and so on. And because like in our space, again, the value is apparent well in advance of when it's apparent on an annual income statement, right? But yeah.
All right. UGE acquired projects in Oregon and Texas recently. Given your cheap stock price and larger backlog, could you expand on why the company chose to acquire projects versus buy back stock? What's the cheapest way, or why did you view that as being the best use of capital?
Yeah, I think there's a few aspects to it. Now, number one, I'll remind everybody that we haven't raised equity in almost 2.5 years, I think. So it wasn't like we had you know what I mean. So a couple of things. One is one of those projects was in Oregon, one was in Texas, and those are two states that we quite like. And so those were opportunities for us to enter those markets. Number two is that those, in both cases, cleared our hurdles for what we were looking to earn on those projects from a levered and unlevered IRR. Each case was a little bit different, but in the Texas case, it actually came with so there was one project that was in construction, and then there was two other projects that were in somewhat earlier stages of development. One's going to be at NTP here in the next few months, and so it was an opportunity for us to get one project close to commercial operation, but then also bring in our development muscle for the other two. And then also the Oregon project, it had an interconnection upgrade payment to the utility that was due about a year out from when that project reaches commercial operation, give or take. We tapped our development capital line to pay for that. The smaller developer that we acquired it from, didn't have the capacity to do that, right? So this was an opportunity for us to use our greater access to capital and so on to bring that project onto our balance sheet. So and maybe one other thing I'll say is, like, as we have our heads down here on building up the overall portfolio, we really believe that as this portfolio grows, it'll just be impossible to ignore the kind of the IPP aspect to our company and the way that such companies are valued, which is not how we're being valued right now. And so if we can accretively add assets like that, I think we definitely should.
And did the price you bought those assets at, are those consistent with the value parameters you had previously been discussing for your assets?
Yeah, so one thing I will say is, like, if let's say that, okay, so Oregon was a 3.5 megawatt project with this 1 year interconnection thing. Texas was a 1.4 megawatt project with the other couple of assets attached to it that were earlier stage of development. If we were the cost of capital required to go out and buy like a 20 megawatt portfolio of community solar assets right now, you'd be talking about paying like that $1 a watt type of number, and that's just not interesting to us. Like that's not accretive in our opinion right now. But those assets that I just mentioned, because of the specific reasons attached to them, it was the kind of the in our mind the cents on the dollar aspect.
Okay, so it was priced well so that it made sense.
Yeah, we know, we in essence know our role, right? Like we know we've looked at portfolios that were like, we've looked at portfolios that were, say, 2 years away from NTP, and so they were being sold kind of cheap in terms of cents on the dollar, but we knew that in-house we could bring those projects to NTP. Don't put it past us to find the right opportunity there. We'll see. But yeah, we're going to make sure that anything we do there is accretive.
Gotcha. Are there any plans to operate in Canada?
Well, so the sort of the Canadian version of the Inflation Reduction Act, which is fairly recently announced here, is certainly interesting. And it's, for anyone who hasn't followed it, it in many ways tries to emulate the US system. So so we are looking at that. No explicit near-term promises, but but it is something that's pretty interesting. We have quite a bit of background and history in Canada, so some of our teams based in Canada as well. So to the degree that sort of investing our next dollar in Canada makes sense, we will.
All right. What is the implicit discount rate used by independent third parties to calculate the fair market value of your projects?
Yeah, I don't know that we've explicitly disclosed that, and I'm not even sure that the third party appraisals explicitly disclose that either. They look at the overall market to see what projects are trading at, et cetera, to see what the FMV will be. Maybe the only thing I can add is, historically we've put like a 10% or an 8% at different times discount rate in our projects, and that's seen as really conservative. And so every single appraisal we've done, it's come out well in advance of the sort of FMV that we were holding ahead of time. So yeah, so I won't put a specific number on it because even different appraisal firms might use a different number.
All right. What is the cost of your debt when you're getting these green bonds and the debt on your balance sheet? Like we've seen interest rates go up a lot over the last year. How has that impacted your interest rates, and what can you get debt for?
Yeah, so the debt that we just closed on for the three main projects was at 5.79%. That was just in the last few weeks here. So that was something that we're quite happy with. I think that probably generally term sheets we're seeing right now are probably between mid to high fives up till like mid to high sixes or something like that is where we're seeing debt rates at, which we think is quite strong. I think maybe that's 100 basis points above like AAA corporate bonds at this point or something. And then we also have our green bond product, which has been maybe a little bit of a victim of the higher rates. The coupon that we've been paying on that has been 9% of late, but also we think that's a pretty attractive source of capital versus issuing equity or what other developers can get, frankly.
All right. How big is the impact of the investment tax credits on net retained value? If a project fetches a 40% tax credit, in a 40% instead of a 30% ITC rate, what additional net retained value per watt can be expected?
I think that the simple math, if we're talking about a 10% delta, 40 versus 30, then what it should flow down to ultimately is a 10% difference off of the appraised value. So if we're talking about 330 or 340 a watt, then that 10% is an extra, call it 33, 34 cents per watt, give or take, of net retained value.
All right. Between November and the end of Q4, your pipeline grew by 930 megawatts. How is such a massive increase possible in just a month? How many projects were there?
I don't know the specific numbers off the top of my head, but yeah, we have a good team that's been really active. I think that yeah, our Q1 we did more than 50% of our backlog goal for 2023, but I think the pipeline activity shows that maybe we're sandbagging there a little bit. So I'll give all the credit to the team there.
All right. And does that maybe, like, there's always some randomness on timing when certain things happen, given that there was such an influx, does that imply that maybe things could slow down a little bit for the next while as maybe some projects were pulled forward in some way? Or
yeah, I mean, there definitely is an ebb and flow that people should expect. I think that development is inherently variable. It was what was it, maybe just over a year ago, where Maine made a tweak to their policy, and it took some megawatts out of our backlog. No projects were lost, but it decreased the size of several of our projects in Maine. You can have upside too. Maryland is a state that's increasing the size of their portfolio, their community solar program. So it can go both ways. But yeah, I think we have a team that's just gotten better and better over the years, but there definitely will be a natural ebb and flow.
Gotcha. And another question going back to your Oregon project that you acquired, the 3.5 megawatt project in Oregon closed in October and cost some 900 grand US, which is about 26 cents per watt. How did you get such a favorable term for a project so close to NTP? Shouldn't it have fetched closer to maybe 70 cents per watt?
Yeah, and I touched on this earlier in the sense that it was a small developer in Oregon, and there was this interconnection payment that was needed to, in essence, bridge about 12 to 15 months from the point where we acquired it to the point of, I think it's commercial operation, and so that that was something we were able to fund through a development capital line, but yeah, I think that allowed us to get our foot in the door accordingly. So maybe the other way of asking that question, like, when that project's ready to start construction in, I think it's a few months now, hypothetically, could we sell it at 70 cents? I know it's just sort of like a finger in the air number, but yeah, I think it probably could be.
All right. What happens when you incur cost overruns in the 6 to 9 months between NTP and the COD? Does that eat up gross margins or developer fees? Does this occur often?
So maybe I'll say, like, when we're doing our deployment or our EPC budget, we hold a contingency in there, we hold a buffer. In the recent inflationary environment, we've probably used up that buffer more times than not. But like, big picture, it hasn't been something that's been like maybe what I'll say is, like, actually during the last couple of years, the much bigger thing, which was to our benefit, was just how much revenue rates increased on these in these markets, and so that more than compensated for any inflationary impacts on the EPC cost. So as a developer, we are as a developer, we're taking that risk. I mean, that's why we earn the returns that we do. But if we're talking about $1.30 of sort of net retained value on a $2 build cost, I guess what I'm trying to say is, like, there's a lot of room in there, and we haven't seen that be a significant anything. It hasn't significantly impacted any projects.
All right. Here's a question I like. What is the reasonable expectations of how much of your backlog gets to NTP level? Does 100% get to there, or does some fall off in between for whatever reason?
So I flipped to this because there's a value number in there. I think it's more than $10 US per share, not Canadian. But in terms of, like, what percent fall off when it's into backlog, like, we're 90+% confident that project's going to reach commercial operation. Now there is variation around, like, the size of projects sometimes, and it can go in both directions. And, like, one thing we're starting to see sometimes is, hey, maybe it was making up a number, a 4 megawatt solar project, but now we're going to add 2 megawatts of storage to it, which is in essence increase the overall value of that project by 50%. It can go in both directions, but yeah, I would say at least 90%.
So 90% of those projects make it to NTP, and 10% maybe fall by the wayside.
Something like that.
Okay, gotcha. Is there any credit risk when you send a bill to a community solar user and they won't or can't pay?
So in the way the short answer is okay. So if you think about it this way, I don't know why I always choose Home Depot as the example here, but it's kind of like you're generating gift cards against the utility, and so those gift cards have, like, there might not be a dollar bill, but it's a pretty close proxy to a dollar bill, and so if there is an aspect of these community solar projects where you have a basket of people buying those credits, and if somebody drops off because they don't pay or they move or whatever the case may be, then you sell those credits to the next person in line. So there is the potential for some level of slippage in these things, but we factor that into our model. We hold an assumption for such things, but it's not too material of a number.
Okay, so people have to pay their utility bill. Yours is basically stapled to the utility bill. So yeah, all right.
Yeah.
If your project,
I would even say, Martin, sorry to interrupt, but I would even say, like, if you have like a power purchase agreement with one off taker, well, your credit risk is binary in essence, right? But with these community solar programs, you might have 100 or 200 off takers within one project. So actually that diversified aspect can be a real benefit.
Yeah. Okay. If your projects that hit NTP in Q1 alone are worth roughly 13 million and your market cap is only 30 million, why not buy back shares aggressively?
Well, I'll say this. As the cash flow profile of the company changes, if that continues as we start to generate cash, then yeah, why wouldn't we buy back our equity? I mean, that might be the best investment we can make. So, this right now we're heads down on deploying these projects and getting more projects into deployment, but I'm not opposed to the idea.
All right. On the last webinar, a comment was made on rules changing for ITC being based on cost instead of appraised value. How would this impact your business going forward?
So there's actually so what this is the Inflation Reduction Act opens up another, like actually a couple additional ways to monetize the tax credit. So which is good news. You can still do the partnership flip like you always did, which is based on the fair market value for projects. There's something called transferability, which instead of doing a partnership flip, which probably spend a whole session on that, but in essence that's like the traditional way of monetizing tax equity. Transferability allows you just to sell the tax credit specifically. Now, what people are toying with is how do you get adequate value for that? Because a partnership flip has always been based on, or more or less always been based on, like this fair market value type of approach. And that's a bit of a simplification, but that's sort of the de facto standard. Whereas with transferability, people are saying, well, how do you make sure that you're on side with the IRS and get like the proper sort of like the fair market value for these projects? And so literally in real time right now, you're seeing, I've seen some folks say, oh, okay, hey, if you sell 20.1% of a project's equity, that establishes the basis for fair market value, and that allows you to not use the cost basis, but use the fair market value approach. There's different ideas like that are coming up. I've seen other people say 10%, et cetera. It's all sort of people trying to find ways to make the tax equity market more efficient. There's no negative right now in terms of what's come through the Inflation Reduction Act. It's all positive. It's really just sort of playing out how best to leverage it.
All right. Any plans to uplist to the TSX?
Yeah, that is still in our short to medium term plans. So we're into 2023 now. I think that so we're actually, I think one of the, like, for example, TSX companies report typically within 90 days and 45 days and things like that. So we've been mostly keeping to those standards, starting to do the quarterly reviews, which you don't have to as a TSX.V company, but you do as a TSX company. So we're setting ourselves up for an uplisting to the main board. I'm not going to give a specific date on that, but it's in the kind of short to medium term future here.
So it could, let's say, possibly be a 2023 event?
Yeah, I mean, 2024 might be more likely, but it's in that time frame.
Gotcha. All right. What percentage of annual revenues does a project generate in each of the 4 quarters? What kind of seasonality? I would guess winter is seasonally, you sell fewer electrons than in the summertime?
Yeah, and this would vary by market. And I don't have the number in front of me, but if you take the two shoulder months or whatever, or a quarter, sorry, of like Q2 and Q3 in the Northeast, you're probably generating, let's say, let's say something like twice as much energy in Q2 and Q3 as you are in Q1 and Q4, or something like that. Like there is a change there.
All right, but presumably in Texas or so, not nearly as much of a change, a seasonal change.
Correct. Yeah.
All right. Does the significant value creation engine, quote, slide include operating expenses at UGE in that valuation? So the slide we're looking at right here, does this include operating expenses?
Yeah, no, good question. So this very much is project EBITDA. And so this is looking at the value of the portfolio. So the you would need to subtract the operating expenses of the operating company here to
the corporate expenses,
yeah.
listing fees, your salary, the head office fees, and everything like that.
Yeah, one thing I said on the webinar is like, our annual overhead right now is in the mid to high single-digit millions, we're at a point where we're in essence having a throughput of 100 megawatts of assets per year, and we're here talking about $1.30 a watt for those projects. So we're talking about spending less than 10 million to generate over 100 million of sort of value creation each year. So I think good not to lose sight of that point.
All right, we're deep into this, well over an hour here, Nick, and we have finally run out of questions. So I think we need to start wrapping things up here. Your news flow is fairly, you don't do, like, it's clear what your business model is here. In terms of news flow coming over the next little while is going to be when you do you announce every project that goes to NTP, and what other sort of news items should we expect through the remainder of this year, let's say?
Yeah, so we do put out a quarterly milestones press release and a newsletter that goes with that, we have been making that more robust over time. We included some charts, etc. this time, and so that'll be the first thing. And then in terms of NTPs, we typically announce NTPs and CODs. Apologies if we miss any, but that is something that we typically celebrate right now as we focus on scaling the portfolio here. And then taking a step back, I mean, we're active in terms of project fundings and developing of projects, et cetera. So yeah, we don't put out news for the sake of putting out news, but I'm sure we'll be busy on a lot of fronts here.
All right. Well, with that, Nick, thank you very much. Thanks for joining us. That was super in depth. I learned a lot. It really, for me, clarified, because your business model was different when we first met almost a decade ago. It's clear now you're an IPP, and that. So this was very helpful for me understanding your value creation and what you've been up to and what the path forward looks. So thank you very much for taking the time to walk us through all of this.
My pleasure, Martin. Thanks again.
Cheers.